All right. Hello, everybody. Thank you so much for jumping on. We're going to get started in just a few minutes, but thank you again. We're looking forward to sharing some knowledge with you about non-QM and how you can open up your pipeline a little bit and find some of those deals that you thought might have been so last year or just no good. All right, Landy, go ahead, give yourself an unmute. We're going to get started in just a few minutes. But today, like I mentioned, we're focusing on non-QM and how you can kind of find some more deals that maybe you thought were not going to move through, or you just really aren't sure how to navigate those waters, whether they're self-employed, they're a foreign national, anything like that. These two loan officers, Pat and Landy, are going to give us an idea on how we can make that happen and really get stuff done. So we'll get started in just a few minutes. We'll give everyone a few more minutes to jump on, and then we'll go ahead and get going. Pat, Landy, you guys both have kids, right? How do you guys manage that work-life balance?
We don't.
We don't.
That's a constant juggling act, right, Pat?
Yes, thank God, my wife downstairs. Yeah.
Yeah, it's definitely tough, but it's good to have a why, you know? Always your why, not your why not.
Mhm.
Yeah.
All right, so we'll go ahead, we'll dive in. We'll start with some introductions, and everyone can kind of tell us a little bit about who they are, what they do, and how they're going to make a difference for agents on this call today. So I'll be co-hosting with Jason. I am a realtor of 10 years, and I work with the corporate team doing social media. So I am in the same boat as some of you guys, being a realtor myself for a while now and helping buyers and sellers make moves. So I'm really excited to bring an extra bit of knowledge to other fellow realtors today and hopefully find some more deals in your pipeline to get to more closings and hopefully get some more money in your guys' pocket. So Jason, go ahead. You take it off next and tell us a little bit about yourself and what you do with Annie Mac.
Hey, I am a divisional sales manager with AnnieMac. Happy to be here, and thanks so much for your time. We know it's important, so we're going to hopefully make this chock full of good information and some actionable steps that you can take as well. And I basically support our sales teams and help them to grow. And one of the biggest ways we do that is by partnering with realtors and figuring out ways to help you grow your business. And this is some ways today, hopefully, that we're going to help you do that.
Yeah, you know it. They're going to find lots of ways today. So go ahead, Pat, tell us a little bit about you, what you know about non-QM and how you can help these people level up.
Yeah. Pat Villano with Annie Mac. Been in the business for a little bit over 20 years now. I'm a dedicated NQM, non-QM mortgage banker. Very happy to be here and help loan officers and realtors understand the products that are out there and help them gain more business.
Perfect. That's what we like to hear. Landy, last but not least.
Landy Garcia. I am co-area manager of the Neighborhood Mortgage Group. Been with Annie Mac now 13 years. Been an originator in the residential space for about 22 years, and really using non-QM to set our business apart and help our agents and more buyers get into homes.
Perfect. That's perfectly put. That's what we like to do here at AnyMac. We like to get more buyers home. That's definitely important to us. So we'll give a quick overview on what exactly non-QM is, because some people might not know. Me, myself, being in the business for 10 years, I didn't really know all the way either. So I'm glad that everyone's here to gain some knowledge. So Pat, Landy, if you guys want to jump in and kind of tell us what exactly non-QM is. And
Sure. Non-QM is a products that don't fit your conventional world, and there's many different products out there that allow different kind of structuring to meet every buyer's, refinancers, homeowners needs to get into a home, either it's investment property, just a home to live in, multifamily, mixed use property, all the way up to 10 units can be done as a non-QM transaction. And the product consists of either qualifying on a bank statement qualification, either deposits into the personal or business account, or we can get rid of that as well and do only cash in the bank and use that for asset utilization. And we come up with a formula that allows to put the cash towards income and qualify with that structure by itself. And then we can also do a flip-flop of W-2 income with bank statement income, a 1-year tax return, a 2-year tax return. You can also structure a P&L program without no tax returns. No income at all as well. You will pay a little bit of a premium in the interest rate for that if you're going to structure on a no income ratio type loan. I mean no income at all. It'd be nothing needs to be shown, just down payment on your property or equity as well, depending on if it's a purchase or refinance. And also allows credit scores to go down to the 620 range on all products. So there's definitely a product to fit every person's interest. Either they can qualify with like I said, no income at all.
Yeah. So to add to that, right? So if you're thinking about your standard process with one of your buyers, they come into your office, they're interested in a property. You're used to dealing with what's called typical financing or traditional financing, right? So some agents, will typically ask for tax returns, pay stubs, W-2s is what as the requirements for them to be able to obtain a mortgage, right? So the non-QM world or non-traditional financing encompasses all of those programs that Pat just described, basically everything that falls outside of that standard box, right? So self-employed individuals or basically individuals that don't show, sufficient income on tax returns or just have unique scenarios fall into that non-traditional or non-QM space.
right.
If I could just add a slight technical piece to that. So the phrase non-QM, a lot of people don't know like what that means or what it stands for. It just stands for non-qualified mortgage. And a qualified mortgage, like Landy was saying, is more of your traditional government agency loans, conventional FHA, VA. And what happens is those loans can be sold on the secondary market in these really, really large pools. And because of that, there's a lot of appetite for them. They have an implicit backing by the federal government right now, so they're considered really safe. What what a qualified mortgage means simply is after 2008, the CFPB created a rule that said if you're going to do a mortgage, it is going to be considered qualified, so it fits in those large pools of bonds that get sold with these mortgages all packaged together. A qualified mortgage means that you have done an analysis to make sure that the borrower has the ability to repay the loan. So you might have heard that phrase ATR, ability to repay. So if there are typical kind of strict guidelines for how they qualify or require us to qualify a borrower and their income under those traditional programs. What non-QM does is it says we're still going to do an ability to repay. We're still going to make sure that they're able to hold the loan, to make the mortgage payments. But there are different ways to do that that aren't quite as strict as the traditional loan methods. So they're called non-QM because we're doing income or qualification programs that are outside of those typical strict pieces. And because of that, there's a smaller pool of buyers out there for those mortgage bonds. And because there's a smaller pool, the pricing tends to be a little bit higher. There's a little bit of a premium for that. That's why the rates are a little bit higher. So it's more flexibility, but they're still very responsible loans. They typically require a little bit more down, although not always. That you can still do low down payments on some of these. But what it is not is it's not subprime lending. This is not 2008 all over again, where people are giving out loans willy-nilly, and it's so creative that we're putting people in things they shouldn't be put in as an industry. Those days are gone. This is creative yet responsible financing. It just doesn't fit into the CFPB's definition of a qualified mortgage. That's where the non-qualified mortgage or non-QM comes from.
Right. So these non-QM loans are for people who are, like you guys mentioned, self-employed, people who are hairdressers. Maybe they have one of those salon suites and they kind of do their own thing, and they don't have a typical W-2 like they would if they were working in like a larger salon or something like that. Real estate investors, foreign nationals, anything kind of like that. That's what a non-QM loan is for, is to get those people into homes because they don't have that typical stuff. And I know on my buyer consultations, I tell people to start getting their documents together. And I have had people say, oh, I don't have a W-2. Well, I didn't file my taxes last year. And it's like, well, before non-QM, we would say, well, sorry, good luck, keep renting. But now with Pat and Landy and Annie Mac and everything like that, there's the opportunities for those people who typically would shy away because they don't have that typical financing and that conventional inside the box stuff. So how does exactly non-QM open up realtor pipelines? Like how are these people going to get into homes? What's a good way to kind of give them tidbits on how they can guide buyers to not be so frightened when they say, I don't have a W-2 or I don't have a 1099 or something like that?
Right. So we as an organization, and any one of your Annie Mac loan officers could assist you with this. We have a committee where you can basically put in the parameters of your prospective buyer or client and get them guidance on which is the best path for them with a non-traditional or non-QM mortgage, right? So it's a no buyer left behind campaign, right, that we have as an organization where we basically can figure out which is the path of least resistance, which is the loan that best fits that potential buyer, right? So in my experience, self-employed individuals typically have a pattern when it comes to what they file in income tax returns, right? So one of the benefits of being a 1099, an Uber driver, a hairdresser, a contractor, a landscaper is that, you have a business that generates income, you have the ability to write off expenses against that income to reduce your tax liability, but all is well until you go to apply for a mortgage, right? There comes the challenge. So we have people that have the ability to repay, generate sufficient income to afford that mortgage payment easily, but their documentation doesn't coincide with that story, right? So we look at bank statements as an easy alternative because the business bank statements will reflect the true depiction of what that business is generating in income, right? And we can average those deposits, taking accountability for what their expenses are going to be. And typically, we'll see a lot more income in those average deposits than we do on the tax return, right? And for that business owner, it's much more advantageous for them to put more money down than to increase their tax liability by increasing their tax returns just to qualify for a traditional mortgage. So as an agent, you could look back at some of the clients that you've spoken to that maybe weren't ready or had that challenge with obviously showing low income on a tax return and present this alternative. And this is just one of many alternatives, but it comes to mind agents that I've helped and our team has helped convert those clients into bank statement approved loans that otherwise would have fallen by the wayside or people would continue to rent if we didn't present those options.
Yeah, definitely 100%. Pat, do you have something to add to that kind of
I was
guidance?
going to answer Sharon's question in there about do you have to have 2 years 1099s? So there is a program for that, but if they do not have that, there's different ways to structure it as far as maybe a P&L where they don't have to have 1099s, maybe even a bank statement transaction of deposits into the personal or business account where it can offset and not show in 1099.
AKA, there's a way around everything.
That's correct.
Pretty much. Pretty much.
Yeah. And like Landy mentioned, our No Buyer Left Behind campaign that we have a desk full of people whose job it is to find every single possible solution that could work for a buyer to get them into a home. Whether it is spending some time, maybe 3 to 6 months, and explaining to them that they need to save a little more for a larger down payment, or letting them know they need to work on some credit or do get some kind of documentation going. That's what that desk is for that we have at AnnieMac exclusive here that really makes sure that no rock is left unturned.
I'd love to share a little story about that, Haley, just as an example. So the loan officers that you work with as your partners at AnnieMac right now are really, really skilled. They are excellent at what they do. And hopefully you utilize them as a resource. Since 2008, a lot of realtors may have been feeling like it wasn't worthwhile to even ask about some non-traditional financing because everyone thought it was such a kind of a third rail after the whole subprime piece in 2008. And with this new no buyer left behind philosophy that AnnieMac has just kind of taken and embraced and just taken to a whole new level, those loan officers that are excellent at what they do, if they can't figure out how to get someone approved, we have a team of people that they go to. And as a committee, we look at that loan and those buyers and say, how do we find a responsible loan for them? How do we get them into a house? That is the entire goal. And just as an example, I mean, Landy and Pat do a significant amount of non-QM, but as an industry and our company in comparison to the industry, we are at least 1.5 to 2 times the average percentage of volume than the norm in non-QM, which means if you look at a typical bank out there, they have some people that may understand it. They have some ways to get it done or figure something out. We are all in on non-QM as a way to help borrowers get into homes. And that's what the No Buyer Left Behind program is all about. So just as an example, we had a loan officer that met with the realtor. The realtor had explained that they had 7 lenders turn down this couple. They were living in their parents' basement with 3 kids. They own a company, and they were told by 7 lenders, you don't qualify. There's no way we can get you qualified. Tell your accountant to start showing more income on your tax returns and just pay your taxes. And she said, I drove them around for months and months and months. I spent all this money on gas. I spent all this time away from qualified buyers, only to find out that they couldn't get approved. And she said, is that something you could look at? And he took a look. He figured out a bunch of things on his own, but just to be sure, he went to our No Buyer Left Behind team. They looked at it, and within 2 days, they had the couple approved with an income of $9,000 a month. And I'm sure if you guys have ever had buyers that were living in their parents' basement with 3 kids, almost the first house they saw, they fell in love with. Their average loan sizes out there are pretty high. So they unlocked commissions over $20,000 for this realtor that already had time and energy and money spent showing these people and felt horrible that they couldn't get them into a home. And this unlocked a home for those buyers. It unlocked a basement for the parents, and it unlocked a commission for the realtors. And that's the type of teamwork and focus and planning that really that No Buyer Left Behind philosophy is about with your loan officer here at AnnieMac.
Yeah, definitely. Turning no's into yes, 100%, and building relationships at the same time. So now those buyers are thinking so much like thank you to their agent and thank you to their agent for connecting them with an AnnieMac LO. So what we like to kind of do here is switch the mindset. You really don't ever have to say no. If you want to give someone a try, you say, yeah, you know what? Let's turn that into a yes with AnnieMac. Let them find you a good solution that's going to work for sure. Pat, Landy, what kind of objections do you guys usually get when you're out there and you're talking to people and they're saying, well, I know it's just not going to work. So like, don't waste your time. How do you navigate that with a buyer?
Just asking the right questions of how their income is derived, how long they've been there for, what they deposit in the bank on a monthly basis. Do they have an accountant who can possibly structure a profit and loss statement for them? Do they deposit money into their personal account as well? Did your tax returns show more in 24 than they did in 23? Maybe we can just get rid of 2023 and choose 2024. It's just a normal question that you would ask, and just a little bit more of information that that leads us to knowing how their income is derived.
Right. So, I think the loan officers at AnnieMac know they have this committee behind them. So now we speak with a little bit more confidence with, just thinking outside of the box, right? So we're looking at every scenario a little bit closer. And if it falls outside of that traditional financing, those traditional requirements, most loan officers just say, all right, well, we don't have an option, right? So the more and more we do non-QM, the more we dive into different investors and seeing the options that we have, we really, find a way, obviously within reason, and that's responsible, but there's so many investors that we as an organization have brought on, so many investors that we're delegated with, which, for those that don't know that term, means we have direct underwriting. We underwrite in-house, so that keeps the control within our four walls. It gives the customer a better experience, and we control the process flow. So we really just can combat any objection with, well, let's just take a closer look, because there's, outside of the traditional FHA, conventional USDA, VA, there's this whole world that exists that we're a part of now, right? We consistently add investors and add products and add programs in order to fit more buyers into homes and fill those needs that are out there.
I will say there's a product for 90% of the buyers out there that don't believe there is one.
Right.
And the only thing I would, I'm sorry, Haley, just on an emotional note, originating for 20 some odd years myself, there's nothing that makes me more sad than seeing people who want to own a home being scared to ask if they could possibly buy something just because they're not sure of their financial situation. So for me, I would just stress that anybody and everybody should at least ask, and you should encourage people that if you're talking to them, there's no judgment, there's no harm, there's no foul, there's nothing but potential upside. The worst you're going to hear is what you're nervous about, which is not right now. Here's a plan. But I hate to see people scare themselves out of an opportunity when that fear is unfounded, and we're really, really good at getting folks through that.
And to answer, I guess, one of the questions in the chat, this does apply to foreign national buyers and refinances on a secondary home basis, unless they have a visa in the U.S. or U.S. social. But if they do not, they'll be treated as a true foreign national, as a second home, and bank statements, yes, can be translated to U.S. and be qualified that way. And the max LTV on that will be 75%.
Nice. Thanks.
Why are foreign nationals such a big question? Sorry, Hale. Why do you, because I know that comes up a lot. What's your experience with that foreign national question, and kind of why people ask that?
Well, foreign nationals have better perks than citizens do as far as getting a home in the U.S. because their income is only a CPA letter, and that's it. You don't have to verify anything else. So if an accountant is going to write a letter saying they made X in 23, X in 24, that's going to be their income that you put on the application. And foreign nationals are just very happy of even getting a home in the U.S. on a secondary basis. And then they go for it, and then they will transition into a visa and getting their U.S. social, and then that home will become a refinance into a primary. and maybe even turn into them working here in the U.S. and then be a full blown non-permanent resident.
Nice.
And especially with FHA recently not allowing financing for foreign nationals, this now is an opportunity for foreign nationals to be able to buy. Just because FHA said no doesn't mean there's not a program for them. So,
And no U.S. FICO is needed, so no scores is required. And pretty much all the countries are, you can make a loan from, except a few.
Wow, that's big for sure. 100%. Landy, tell us a little bit about how real estate investors can get this done and how you structure their stuff.
Right. So there's definitely a lot of opportunity for agents to engage in the investor space. So the DSCR, or the debt service coverage ratio loan, is a program through the non-QM space where you're basically qualifying off of the rental income that property generates, right? So the individuals applying for the loan, their personal income isn't part of the equation, nor are their liabilities, right? So we're looking at the property and its ability to cash flow as the main source of income to qualify for that mortgage. So if you think about, investors will typically have properties that they're buying, repairing, and maybe they're looking to hold those properties and move on to another investment. You can suggest, hey, listen, speak to my loan officer. He'll be able to get you some money out of that house so that you can go and invest into another property. That's a common problem for investors, is they purchase a property, invest into it, and then the money's tied up. And the equity in the property can yield them a cash out refinance where they can take those funds and reinvest them. If you're a first time investor and looking to purchase, 2, 3, 4 units, there's options where, again, you don't need to necessarily have a strong W-2 or a tax return to justify the income to qualify for that loan. We're looking at, does that property's rental income that's confirmed by an appraiser cover the mortgage payment? If the answer is yes, that loan is approved, right? So you're dealing with your typical down payments for investors, 20-25% down, but the process is that much easier. And one thing that's key for investors is that the title can be held in the name of an LLC, right? So the property or that mortgage isn't attached to their personal name. It can be held in the name of their company. So plenty of success stories with agents within my network that had investors that always had the challenge of, if they have multiple properties, so for example, a traditional loan, you can't have more than 10 properties before it starts to become a problem with conventional DU or LP, Fannie Mae financing. So with the debt service coverage ratio loan, or the DSCR, those rules don't apply, right? An investor can buy as many properties as they like without having their personal income attached to the loan or having that property attached to their personal name. It can be all under the name of an LLC, which is very attractive to investors. And you, as an agent, can be the professional to guide them in the direction of, listen, speak to my loan officer at AnnieMac. They can set you up to get the money that you just invested into 123 Main Street so that we can go and buy more properties. So you think about the opportunities that exist there by you just being able to unlock that equity for that investor, the possibilities are endless.
Yeah, that's awesome. Also, I love how all of us always say 123 Main Street. Whenever I'm talking about it, that's my go.
That's the hypothetical address.
123 Main Street is the go-to every time.
And then again, just a quick story to add. The reason that Fannie and Freddie were initially created charter-wise was to help people get into home ownership. It really wasn't created for second homes. It really wasn't created for investment properties. And what we started to see over the past 4 or 5 years is that they have started to add price adjusters to those second homes and to investment properties, mostly investment properties, that really increase the rates considerably compared to what a regular conforming rate is that you would see, from a conventional loan. And we had a person that moved into an area with where one of our loan officers is located, and he was talking to this person. They were in the medical profession, and he said that he owned 3 or 4 investment properties, and he was thinking that he'd like to buy something and then an investment property as well. And the loan officer said, I can certainly help you with that. And the buyer said, well, the problem is it was such a pain last time. I had to give them all my tax returns. They asked for X, Y, and Z. Then they asked for more documentation. The more properties I owned, the more documentation they asked for. And the loan officer said, let me ask you a question. If I could get you about the same rate, maybe 0.25% higher in this specific example, but you wouldn't have to do any of that. Literally, it's your credit, your down payment, and then the property stands on its own, meaning the investor just wants to make sure that if for some reason you don't pay that mortgage and they have to take that property back under foreclosure, that the rents will cover their carrying costs, right? That's really their goal with what a DSCR loan is, or that debt service coverage ratio loan is. So that saves that person tons of time and money with their accountant, tons and headaches, and they were all over it, and they could not believe how easy it was. And now they're able to increase their portfolio with much fewer headaches, and in the name of an LLC, which has a lot of benefits for them as well financially. So
Yeah, for sure. And liability wise too, that's definitely a win for sure, not being in your personal name. We have a question here, Pat. You want to take it? Landy, you want to take it? What do you want to?
Sure. So given the right structure, you can possibly go up to 85% loan to value. That would be on a DSCR product, probably on a 1.0 ratio. Rates can go from probably 8s and 9s if you're going to go up that high. But keep in mind, there's also no PMI.
Mm-hmm.
So I would say if the loan is structured properly, possibly 85% would be max.
Yeah, we had a question asking what is the typical down payment required for a $600,000 purchase, roundabout interest rate. So Pat's talking, 15% down would be the usual, and then your interest rate would probably depend on the buyer, as we all know, roundabout in the 8s, 9s.
Right. So the interest rates are going to be dependent on credit score and down payment, right? So 15% being likely the highest loan to value, or the lowest down payment, 15% down. Like Pat said, somewhere 8s, 9s, depending on credit. And as you increase down payment, the terms get better, right? So as this sector of the mortgage business has grown, we've seen that the pricing is improving, right? So in some scenarios, you'll see a buyer with, say, a 720 credit score purchasing an investment property, the interest rate being very similar to what it would be on the conventional side with tax returns, W-2s, pay stubs, and basically a more arduous process than the DSCR, or the debt service coverage ratio loan. So for the investor, it's always more advantageous to go with the debt service ratio loan, simply because the process is much smoother. And again, the LLC ownership is huge for investors, obviously, because of the tax advantages.
And a lot of LLCs do not report on credit, which gives them more buying power.
Yep.
That's correct. That's a great point. So the more properties you own in an LLC instead of in your personal name, they don't hinder you from qualifying for a traditional mortgage when you go to buy another property.
I think it's important to note, because some people may live in a resort area, or near schools that have huge football teams or things like that, Airbnbs, we do have investors that will utilize the Airbnb income as part of that debt service, meaning if those things are rented out and they can show that there's a market rate for the rent that is going to cover with a certain a certain number of days rented, et cetera, then that can qualify those purchases as well. So you'll go down to places like, Orlando, or, some lake resorts, some ski areas, and people are using these, the Airbnbs, and just buying a number of investment properties through this program. And it's been really, really good for them, and really, really good for that economy, and obviously for the agents as well.
Yeah, 100%. So talking about just that though, can you use non-QM loans to buy a second home? Can I use
Second home, investment property under the
investment property
same
or a vacation home? Can you use a non-QM to do that as
vacation
well?
home. Even people not might know what this is, which is a hotel and condo, and you can use it as a rental as well. So it'll be a little bit of a mix as well. You can qualify it off bank statements, either second home or investment. Also to throw in there if you want to go for mixed use property,
Okay.
commercial and residential, and possibly even occupy the store as well as your own. So that's also a product that's out there.
Yeah, that's awesome. Do you guys have any great stories that you want to share where non-QM has either created extra stuff or has really saved something that people really thought they were just, it was never going to happen for them?
I'm
Sure.
going to say
Yeah.
there is
So
a building.
go ahead. Go
I'll
ahead.
tell you the story. There is like I said, there is a product for everybody out there. Just needs to be structured properly and in the hands of the right individual here at Andy Mac. So there's might be a few no's to get to the yes, but there is a pathway to get there as long as it's structured properly and all the cards are on the table and we can see how each borrower structures their income or what they're actually looking to do in the future as well. Maybe it could be an investment property now and then later on converted to a second home or a primary when they get their finances back in order. So it might not be the house today, it could be the house for later on and have it as an income property now. And then when they're ready to buy it as a primary, you can convert it that way. So there's a lot of products that that can fit the mold as long as the client is willing to take the risk with us.
Yeah, so I had a scenario that came from an agent, had a client that wanted to list her property for sale. Obviously, the concern was, well, I want to buy another property. Lots of equity in the home. Lady had gone through a divorce, basically had recent lates on the mortgage within the last 12 months and a modification, right? So she'd been in a modification 3 months, making her payments on time. Admittedly, I said, well, with lates in the last year, I don't know that this is going to happen, but let me take a look, right? Let me see what can happen. So and this lady was full documentation, W-2s, pay stubs, had a regular job. Just the mortgage history fell out of the traditional guideline, right? No conventional or FHA mortgage would allow for that derogatory history within the last 12 months. So that's where my mind went. I kind of said, all right, well, this isn't going to work. Lo and behold, we were able to find a non-QM investor that, because of the down payment requirement, that they basically said, we'll do this on an exception basis. We'll bypass the fact that she had those challenges in the last year. She's made 3 payments on time on her modification, and we'll allow her to purchase a new property with 30% down. In this particular case, the lady had so much money coming from the proceeds of her sale. So we were able to fully approve her prior to got her pre-approval, locked in her new property with the agent. The agent listed that property for sale. So we unlocked, the purchase was $300. She sold her house for $600, $900,000 at whatever commission rate that they were earning on those transactions. And we set the lady up for basically a temporary loan because the interest rates and the terms were higher simply because of the challenges that she had with her mortgage history. But she got her new home. We're going to refinance her down the line once she has that 12-month history to fall into a traditional product. But most importantly, we were able to help that family move on and help our agent partner, solidify 2 transactions that most loan officers, myself admittedly in the beginning, I said, this one's going to be tough to get through. And luckily, because of the support that we have with our non-QM committee, I was able to find a path to get that transaction done. So there's, like this story, there's multiple stories that come to mind as just lack of investing the time to learn these products or basically thinking outside the box with our agent partners and as loan officers, really just look at every scenario because, like Pat said, 90% of the time we'll find a home for any scenario.
Yeah, definitely. And that's again, all it took was a little extra time, a little extra looking. Where sometimes if you go to a bigger bank or you go to, Rocket Mortgage, or sorry, I'm not supposed to say that. Oh, my bad. Those online providers. Sorry about that. Everybody's great. Those online providers can get the immediate no, and then these people are discouraged. They're thinking, well, my loan originator said that it's not going to happen. It's not a good. So sorry. Thanks for your time. To where if you connect them with an Annie Mac loan originator, then you're going to get that top-notch customer service that you might not get from those online providers and those big banks.
I would even say your local loan officers too. Your individual one person broker shop or, smaller companies as well. They just don't have the resources and the knowledge that we have. Something that Landy said, when we're offered delegation from these non-QM investors, it's a lot of risk that they're taking. They're basically saying, we're going to let you guys underwrite this loan because we trust your judgment and we know how the non-QM business works. And quite honestly, that's not something that they do for a lot of organizations. And, nothing against any individual or smaller or larger institution. But when you have a team of people that are looking, you're always going to benefit more from shared knowledge of experts, people like Pat and Landy, and our whole back-end group that looks at that as a committee. And it doesn't always end up being a non-QM loan that we figure out works for somebody. We may be able to find a traditional loan that works for them as well. So it just gives you as a realtor another way to say yes, another way to get another commission. You get that commission. And trust me, when people feel like they can't get a loan and you're the one that helped introduce them to an Annie Mac loan officer that was able to get them a loan, the referrals will come because they're so appreciative about that.
Yeah, they're going to tell everybody. Their mom, their dog walker, their mailman. Everyone's going to know. Everybody.
Facebook.
Facebook. Experience.com. We have a couple of quick questions regarding credit in here. Somebody's asking.
Yes, so I guess if two borrowers are on a loan, the higher wage earners credit score will be used. So if two borrowers.
And what's the difference with that, Pat? Like, why is that? Why do you think that's an important thing to?
So if you have a married couple that one's making $60,000 a year and one's making 80, and the 80 has the higher and the other one has the lower, usually banks take the lower. Mm-hmm. And this one's offset to go with the higher, and you get a better interest rate instead of pricing off the lowest score like it's conventional.
Nice. Okay. We have someone else that asked, what's the lowest credit score that you've been able to get a non-QM loan for?
Myself, 600, but guidelines are probably 620. And I believe we're trying to work on other products that can go down to 580, but not this time yet.
Yeah, and 580 is tough. 580.
Yeah, you have to have a lot of compensating factors to get there.
Yeah, and also too, if 580 is not impossible to do by any means, but it's also not impossible to increase credit at that point. Like you have some serious, like the buyer has some serious stuff that has been sitting on their credit report. Like a couple of phone calls and things like that can really give you a quick boost to get you into the 600s and get you possibly qualified for a non-QM, to where the other loans are more like a 640. Sometimes you can get them down a little bit lower than that, but I would definitely recommend somebody, if they're in the low lows and they're in those 580s, to definitely make a couple of phone calls, because there's a few things that can get taken care of with just a couple of phone calls that and no really money out of pocket.
Right.
One of the tools that we actually have to help do that is a proprietary tool that we can run a scenario. So if you have someone with a low credit score, again, this is the part that I hate seeing people being scared and they don't apply for a loan and they don't look for a house because they're worried about their credit. People make mistakes, right? People have health issues, things come up. So we actually have some tools that we can utilize where we can run a predictor and say, if the borrower has the funds and they do X, Y, and Z, what is a reasonable expectation of what we can do with their rate? And I'll give you an example. I just helped somebody that had a 608 credit score. And of course, the pricing as you go down, typically the costs are higher because they're adding those loan level pricing adjustments from Fannie and Freddie for conventional loans. And we had them open a credit card that they were going to use for like $10, $15 a month and then pay it down to $1 and then 10, $15 a month and then pay it down for $1, kind of use it responsibly and do that over 2 or 3 credit cards. Well, just because they had no credit history at all for the past few years, they got the new credit card, their credit score jumped to a 771 just from getting a credit card. No bad debt, no nothing. They just applied. As soon as that credit card hit their credit report, their credit score jumped up to 771 just from obtaining a credit card. So those are the types of things that your AnnieMac loan officers can look at for you, because we have those proprietary tools to see if we can improve the scores to either get better pricing or get them into a different program.
Right, 100%. Jason, we talked about a couple of tactical things and things that agents can do in the now to get some of this going and rocking and rolling in their pipeline, and some of the people that might have been sitting, or those no's that we can turn into yes. So share some of those with us so the agents have something to take away today.
Yeah, so we like to give you something tactical, not just backgrounds and good stories. So I have a list of 4 or 5 things that if you think they're interesting enough, or if you want to watch the recording later, write them down or pen them out later. But just a couple of suggestions that I think are things that you can do today that will help you to grow your business with some of the information that you got from this call, hopefully. So first and foremost is get in touch with your AnnieMac loan officer. Number one, it's good just to review, talk to them, reconnect with them, but they also can help you do some planning to find some new business, to go after some marketing sources together, which I'm going to give you some ideas here. But again, we are here to work with our realtor partners and help you grow your business. And this is a tremendous way to do it with a great platform. So first and foremost, get in touch with your AnnieMac loan officer as soon as possible and start looking at a little bit of a plan. Secondly is get your folks approved before you take them out and take them shopping. So many realtors I've seen taking, doctors out because they feel like they've got to be qualified, right? And then they find out they're about to make an offer and they say, well, let's get you approved now because we need an approval letter. And they find out that there's credit issues or there's problems. With non-QM, it's going to open up a lot of doors, especially with some of these types of buyers. You want to make sure that you get them approved first. Don't just assume because there's a lot of options that it's going to work for their scenario. So that would be my second recommendation, just for your own time and energy and money savings for that. Third thing I would say is in your area, there are likely investor groups. They have message boards where people post questions. They have them on Airbnb. There's a few national ones online. Go in, poke around, get comfortable with those message boards, and then start to post a little bit. Share your expertise, and people will come to you as a realtor because you're sharing valuable information to them. So that's another thing that you can start doing right away. And then the other thing I would say is look at your database and look at people that you have tried to help that maybe had to fall out of the home buying process. Look at people that maybe you remember driving around and spending weeks or months with them and they ended up not being able to get a loan, or people that called you or reached out to you on social media. Look in your calendar. Go back 2 years and see how many Saturdays you drove around Mr. and Mrs. Smith with their, 3 kids and, melting chocolate into the back seat of your car, right? Like, look at those and see what opportunities you may be able to find for those people to get them to talk to your AnnieMac loan officer to see if we can look at them for the No Buyer Left Behind program. So just a couple of things that you could do also when you're talking to your loan officer from AnnieMac. Talk about going to your CPA or CPAs in your community, financial planner that you use, or financial planners in your community. And if you do it as a pair, if you do it as a team, it's going to help you to look like an expert because your AnnieMac loan officer is the expert. But you're going to definitely get those introductions and those relationships, and hopefully walk away with some buyers, referrals, and commissions from all of this.
Yeah, definitely. So to wrap up too, I just want to talk about our second look program. So this is something too that AnnieMac does, is where they will take a second look at a loan estimate, a second look at someone's pre-approval, pre-qualification, anything like that. No strings attached. No, now you have to work with us, nothing like that. But just to ensure that your buyer is being taken care of properly. Personally, I closed a deal probably about 5 years ago where the I was on the listing side, the buyer had gotten a pre-qualification from somebody that I didn't know, somebody random. But it had closed, everything was good to go. By the time we got the CD, I was looking through it at the end with my seller. I noticed that he was a VA buyer. There was all these random premiums and charges and things. And to do that to a VA buyer of all people is just like extremely like, come on. Like, come on. So this is something that Annie Mac can do and can help to make sure that these buyers are well taken care of, that nobody's getting taken to the cleaners, that nobody's being disrespected or anything like that. So if that's something that you have any interest in, or if you just want to really just get a second look, this is a good place to do it. Again, there's no strings attached, and it's something that we do offer just to make sure that everyone's being treated fairly. All right, Landy, Pat, you guys have anything to add? Any little nuggets that people should take with them while they finish up?
Any questions? Email me or call me. I'll be happy to answer.
I would add that there's endless possibilities with a lot of the non-QM programs that we have. Your Annie Mac loan officers are supported and well equipped to find a home for any buyer out there. I, in my network, have found that a lot of my agents are unaware of a lot of the things that they can do, how they can service more buyers. We're bringing that education forward to them. Your Annie Mac loan officer can do the same, and just bring the scenarios. Don't turn anyone down, because there are a lot of innovative programs out there that can help people stop renting, convert them into buyers. For your investors, there's so much opportunity there because a lot of those investors have equity stuck in those properties that it's challenging for them to get out and to continue to invest. So get creative, think outside of the box, lean on your Annie Mac loan officers to give you the guidance to get more buyers in the contract.
Definitely. Jason, you have anything to add when we wrap up?
Just wanted to say thank you all for your time, and I hope you felt this was valuable. Honored to be on the call with you guys.
Yes, thank you, Pat. Thank you, Landy. Thank you, Jason. Thank you, all agents and everyone else who joined today. We really appreciate your time, and we're looking forward to seeing you guys in September. Have a great day, everybody.
Thank you.
Thank you.
Take care, everyone.
Take care.